we still think that this year will be hell in markets. Okay, it will not be incremental. We think a lot of things that have been moving in an arm wrestling manner will no longer move in an arm wrestling manner. They'll move more aggressively, more dynamically.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Michael Oliver. So Michael's the founder of Momentum Structural Analysis. So thanks so much for coming back on the podcast today.
Thanks, Anthony. Good to be back.
Yeah, looking forward to the conversation. You are sort of a very popular guest, and I think people appreciate your opinions and sort of your analysis of the momentum in markets. So from your perspective, what are we currently seeing in markets at the moment?
Well, we still think that this year will be hell in markets. Okay, it will not be incremental. We think a lot of things that have been moving in an arm wrestling manner will no longer move in an arm wrestling manner. They'll move more aggressively, more dynamically. Gold and monetary metals complex is already exhibiting that. In that since 2015 bear low, we've had an ongoing bull market in gold. Okay, but it's been very layered. It even had a correction one time in August, September of 2022 that actually went down and took out a very obvious set of price chart lows that spooked everybody. It's like, oh my God, big bear market coming. That was actually the first time you'd had a sell-off in gold that took out some lows that were obvious. And in our mind, that was equivalent to the 2008 mini debacle that gold had that everybody seems to remember, only that October 2008 collapse in gold, which was actually a brief interruption in an ongoing bull market then. But we think the action since 2022 and went back to the highs in gold. Silver and miners did not. They were lagging gold. They shift from outperform to underperform. They've been underperforming since mid 2020, early 2021. While gold's been doing sideways, they've been eroding. We think that's changing. So not only do we see enough momentum structural breakout on long-term metrics favoring an acceleration in the gold and silver markets, but we see that the laggards, namely silver and the miners, are shifting to an outperform status versus gold. So watch gold, but it's time now to be back in silver and back in the miners on a percentage gain basis. That's what we see there.
Okay, and that's probably something that, if you compare the appreciations of gold and over the past 20 years versus the miners, the miners haven't normally done too well. So you think it's just
they're at the lowest level in history relative to gold, and the miners relative to the U.S. stock market as well. They're after all, they're stocks, right? Okay. There's some major asset managers out there though, who in recent months, like in mid-February, Stanley Druckenmiller, it was announced that he had bought Newmont and Barrick Gold, which are the two big blue chips in the gold complex. At the same time, dumped three big heavy-weighted tech stocks. So that was a major portfolio shift. I don't know what percent overall of his portfolio that was, but he did make the shift and announced it. And, no doubt other asset managers at that time probably chuckled and said, oh, what an idiot, okay. Meanwhile, if you go back and look at the price chart, Newmont Gold then was trading about $31. It's now in the low 40s. Okay, so it wasn't such a bad move. And I think others are recognizing that and realizing there's something going on there. When you look around and find something that's as dynamic as that on the upside, you just don't find it right now. Even the big tech leading stocks are doing this churning type action for the last several months. Some of them actually eroding down through stuff. But anyway, so I think that there's an asset manager shift into the miners. And because they're so undervalued and they're sold out, basically. In other words, nobody's selling them anymore. They're just, they're depleted. Just they're not being bought. Well, now they're being bought. And it's like grabbing a wet bar of soap. It's such a small little sector that it doesn't take much money reallocation into that sector to cause it to squirt on the upside. I think that's what we're beginning to see.
Okay, that makes sense. But then I guess for the overall markets, you're saying you think there's going to be lots of volatility and I guess lots of pressure throughout the rest of the year. What do you think is going to be driving that?
The U.S. stock market, of course, is different from other stock markets in the world. You can just look at it and see. Europe is not as high relative to its 2009 bear low as we are. Like the S&P is 7-8 fold above its price level of 13 years ago. No, 15 years ago, excuse me. And NASDAQ 100 17 fold over what it was at 2009 bear low. There's no bull market in US history that is comparable in terms of the upward percent gain over such a protracted period of time. And if you look at an M2 chart, or if you look at a Fed funds chart, go back 50 years on both and look at them, and you can understand, especially look at the Fed funds chart, you can understand, oh my, no wonder the tank was so full of fuel. Because for a dozen of those 15 years, the Fed had rates effectively at zero. In other words, money was free. Okay, so if money's free, you spend. Make all kinds of decisions, both family, personal type decisions, corporate decisions, decisions by municipal governments to build a road, et cetera, et cetera. All these things, one of the factors underlying their decision is what is the cost of money? Okay, well, if money's free and it seems to stay free for so many years, then that must be a reality, right? Okay, well, you make a decision based on that, and that's one of your key components. And suddenly this is not true. So it's like pulling a rug out from under all kinds of bad ideas. So all kinds of buildings are going to topple, as metaphorically speaking. And already we're seeing that. The Fed likes to deny. I think they have a political motivation almost to make sure that everything looks good, because they certainly don't want Trump to win. They've already made that clear. He's already made it clear too. He's going to fire Powell. But forgetting that, it's him. Powell getting up after each of the unemployment reports of the last 4 months, say, oh, the job market looks great. Well, actually, if you look underneath the surface, you see it doesn't look great. All the job growth is in government, hospitality, and hospitals. A lot of that being home healthcare. Somebody coming to take care of your grandma. Job growth has not been existent in major core sectors of the economy. And now last month, we suddenly had a report that showed that. And then you have comments from a lot of companies that sell product on a retail basis, like, Target or McDonald's recently, for example, said the lower income category of our consumer is hurting bad. They can see it in their sales, and apparently they can analyze and tell what component of their buying public is hurting. And then the other day, we had Apple announced the biggest stock purchase program. They're buying back their own stock, biggest one in history. And so Apple, which had been under pressure, frankly, is toying with levels down in the 160s. That if you break through it, you're really going to go down big time. Annual momentum says you could go down, you could get cut in half easily. And so they got right down near the level where they couldn't go. And then they came out with this decision. But underneath the second line of that decision was, oh, by the way, our iPhone sales dropped 10%. Wow. That's not a deviation. That's a crash in sales. And that reflects something we said in a report several weeks ago that, iPhones, they're sort of a luxury item. They're very expensive after all. And you can get a phone a lot less than an iPhone with not all the gadgets. And you don't have to update it every year or every 2 years like so many people do. And so if you start to get pinched financially, then you tell your daughter or your son, nope, I'm sorry, you can't upgrade this year, And so that reflects an underlying weakness in the economy. And I think we're seeing that in a lot of sectors, not just Apple iPhone sales. And this is going to come to the surface. And the Fed will have to respond to it because that's their other mandate, unemployment issue. And they have some other big problems as well. For example, they like to talk about their two mandates. One is to subdue inflation, which they misdefine as commodity inflation. It's okay if they inflate stock prices, that's fine. But to inflate the price of corn, that's no good. Okay. They have other problems outside their two mandates. One right now is the Japanese yen collapsing. And you can see that about a week ago, there was intervention in that market to help that currency. You should hearken back to 1997. And there was an event with the Thailand baht currency where it collapsed. So, who cares, right? Well, it affected Asia went into recession, not just Thailand. And it even moved over into the West and it impacted the US in 1998. And so even the Thai baht collapsing, which is hardly a major core currency, it had major wave effects. And I'm sure that Janet Yellen and Powell both remember or have heard about that event and, the wave effects it had. So here you have our club, I call it the club, where you have the Federal Reserve, the ECB, and the BOJ, Bank of Japan. So you have these three, Europe, Japan, US, the club. We're all allies, quote unquote, not enemies. And therefore, if the collapse in one of the currencies starts to occur, like the yen has really begun to, you look at a chart, you can see what I mean. It's alarming because if the Thai baht did what it did, imagine what the yen could do if it went down, and it's part of the club. So, there's going to have to be some implicit or in the dark type policy actions by the other major central banks to help defend the yen. Now that might involve something to do with RT bonds too, because RT bond market is not behaving as the Fed would like it. They control the short end of the market, but they don't control that 30-year bond, and it's been in puke mode for a couple of years, and we had a wave of selling in October 2022, another wave October of last year, then a rebound, which we caught and called and said, get out in December. We had a nice rally from like TLT, for example, went from like 83 to 100. And we said, exit. It's going to be a pullback. We didn't know the pullback would be this deep. So far, we've not gone down to the lows that we saw late last year. But boy, I'll tell you what, if you take bonds through those lows, that's going to spook the heck out of the central banks because those kind of rates are choking people already. And we all know the housing market, those kind of rates are hurting people. And that's at the long end. So the Fed may have paused, but the bond market didn't pause. So they got two big variables out there, potential collapse in the major currency, and two, the collapsing tone of our bond market that are outside their two mandates. They got to do something about it. They can't just say, well, dismiss it. It's too big to dismiss. So they got real problems. And I think gold has known this is coming because it knew we had a bubble stock market that ultimately would have to break, along with other paper assets that are linked to it. And that when that happened, the central banks would go berserk, back to what they do traditionally and what they were created for, namely support the debt of their governments. And that requires massive liquidity, et cetera. So I think that's what's driving gold right now.
Okay, yeah, you covered lots of topics there. So I guess to start, you mentioned that McDonald's and Starbucks and all these, I guess, companies are struggling with, as you said, the lower demographic are struggling for money. So do you think that's just high interest rates sort of permeating throughout the economy? It's finally starting to hit?
Everything. It's everything, I think. When you create a stock bubble that is 4 times the average age of any, like 23 to 29, and then we had a crash that wiped it out, to 1932. It took them 20 years to get back to the high. And then you had the mid 1970s bear. And then you had the dot-com bubble, which was preceded again by filling the tank with low interest rates, lowest rates they'd had in 50 years on Fed funds. And that fuel, that was 92, 93, 94. And then you had this dot-com bubble, take that fuel and run with it. But when that broke, tech stocks went down 82%. And then yet that bull market was only like a triple, and it only lasted about 5 years or so. So it wasn't old, and it wasn't overdone in terms of multiple gains compared to what we've got now. Or take the 2007 top. We came up from a low in 2003 through 2007. You're talking 4 years. Very low rates again helped precede that, helped fuel the tank. And it created a real estate, the mortgage bubble. And at that time, I think it was in May of 2007, as the market was topping, doing this sideways nonsense, which for a year actually back then, Bernanke said, it's manageable. The mortgage problems, it's manageable. That was the term he used. I looked it up the other day, back and looked at his quote. And of course, that's as the stock market made a new high in October of 2007 because the Fed had cut rates in mid-September of 2007. What did they cut rates for? If it was manageable. Well, they knew it wasn't. Anyway, so it fell apart. Well, now recently we have a commercial real estate problem. So if you, for example, look at an S&P chart and then punch up on your screen RWR, which is a REIT, Real Estate Investment Trust ETF, and look at it, you think they're in different universes. Yes, RWR dropped hard in 2022, just like the stock market, but the S&P and the NASDAQ 100, for example, went up, made new highs. You could find 5 stocks that explain that. But RWR is laying in the bottom half of its price range since the 2022 high to the 2021 high to the 22 low. It's laying in the bottom half, dormant. So it's not recovering. This is exactly the same thing that happened to the real estate market back in 2007 when the S&P went up, made a new high, marginally, a teaser new high. Real estate wasn't doing that. Who won? Okay. Well, watch RWR. That's an interesting sector of the market because recently Yellen came out with a statement regarding commercial real estate. And again, her term was, it's manageable. I loved it. So we put that in a recent report. So anyway, watch that. We do not trust the stock market whatsoever here. We think it is a massive bubble in a topping process, very laborious, but topping. In fact, even with the S&P or the NASDAQ, if you had bought CDs or T-bills back when we said sell in January of 2022, just a month or so off the high, we should be out of the market, be gone. Yes, it's made a new high since then, but you'd have done as well buying CDs. You wouldn't have had to suffer through what happened in 2022. So we think it's a topping market. And when it breaks, that's the thing that's really going to panic the Fed into total berserk mode. And monetary excess, rates probably being cut sharply, but also balance sheet. Watch it. Big dramatic changes could occur there. Anyway, it's going to be fun, and I think it's going to be dynamic. And I think gold and silver are telling us that.
Yeah, and if we go back to something you mentioned before about the Japanese yen, I think the concern that the U.S. Treasury has as well is that they have over $1 trillion of bonds. So if they start sort of trying to sell them on the market all at once, China's the same, and they're in a similar position with their currency. So if everyone starts to try to liquidate, that's going to have quite a large impact on the bond market.
It might help the Japanese if we'd cut rates a bit. Make it a little less competitive to the Japanese situation by lowering our rates. That might be one policy, one thing that motivates the Fed to cut rates. They're probably looking for data points that they can now use. And I think the head of UBS was a couple of weeks ago. They issued a report, or he made a statement, something to the effect that Powell is ignoring. How come the question was more like, why is he ignoring the employment data over the last several months? And only pointing to, the final number, which is meaningless because the numbers underneath are telling you a totally different story. And so the head of UBS had doubts about what's motivating Powell to do that, which is, not just questioning his conclusion, but what's his motive for claiming everything's great. Anyway, we live in an interesting world. So, get your seatbelt on, be on the right side, and don't be deluded.
Yeah, it's a good point. So if the Fed were to cut, because I guess, we saw it the other day when you were mentioning the weak employment data came through, and markets bounced off that. They're sort of excited for it's quite counterintuitive, but they're excited for the potential cut. So do you think there's going to be similar effects?
Yesterday was they were happy with the job numbers yesterday. So that, oh God, more jobless claims. Let's go up. Okay, it's really crazy. But if you go back and look at the 2000 top, the Fed had been in a process of raising rates up through May of 2000. Okay, and we got bearish in January of 2000, and the market went sideways for the year. In fact, it made a new high after we got bearish, at 5% or so. It was in August of 2000. And then it started to bleed off a bit, but basically a big range-bound situation after, it was a 5-year bull market and a tripling in prices. There was a lot of distribution. It was very confusing because it wasn't breaking down. But by January of 2001, not too far off the price high, the Fed cut rates by half a basis point. And in other words, they shifted from pause in May of 2000 to an actual cut. Now, there was a rally intra-month that month, but if you sold that rally, you nailed it because the bear market followed, the huge bear market, especially with tech stocks. And they cut rates all the way down as the market collapsed all the way down. And then you go back to 2007, like I said, they cut rates 1 month before the top tick, mid-September. Market peaked in mid-October. So actually, if you just sold the first rate cut, it was a half a basis point. In September, mid-September 2007, yeah, you got hurt for 1 month, but then the market started to collapse and they cut rates all the way down and the market went all the way down. So cutting rates by the Fed is often a great sell signal. So the people who are out there buying stocks hoping they cut rates, go back and look at history, guys. It's not a good idea. So,
do you think the markets have changed since then because of QE and the Fed's willingness to act quicker, I guess, than what they did in 2008?
well, I've heard stories that Powell doesn't like what QE did because he sort of acknowledges that it created the inflation. It never says that explicitly, I don't think. He wouldn't dare because that means we're the villain, okay, the Fed. But no, he'll have to do something, or his successor will have to take steps to shore up the debt market, the government debt market I'm talking about. Because if you look at bond market drop recently, for example, even municipal bonds aren't going down as much as U.S. government bonds. And high yield corporate debt isn't going down in price as much as U.S. government debt. So it's U.S. government bonds this time. And, remember back to 2008 and 9, we had failure of, Lehman Brothers, et cetera. So private companies, okay. Government had to come in and buy out General Motors. I call them now government motors. Obama had them bailed out. But this time around, I suspect it's going to be more government-focused debt that will be the problem than it will be private. So a lot of people are watching banks because we had a bank scare a year ago. We literally had a crash at 30-something% in a week or so. And banks have not gone back to their highs. I'm talking the bank ETF. So a lot of people are still focused on that, but I suggest what they should focus on is the commercial real estate market, not the banks. And 2, watch the government bond market. Because these are things that they get out of hand just a little bit more. Even if bonds, we can see the potential for bonds to have a big rally. Okay. In other words, a big drop in rates, not because the Fed succeeds, but because finally the bond market reaches a level that says, okay, it's an alternative to the stock market, and enough asset managers move over and say, okay, I'll take some bonds now. But the question is, will bonds first go down and take out last October's low? And we're open on that. We don't know the answer. We can see the possibility that we spike that low again, meaning rates go higher than they were then even, before they make a turn. And that will be a panic move. Now, another factor for the bonds, aside from what the Fed might or might not do, is the stock market. Because I think if the stock market does start to break in a way that concerns people, let's say, for example, you're just looking at a price chart. We just made a low in the recent break. Since the April high, we made a low in 4,900 area in the S&P. We're back up to 52. Okay. If you go down to that 4,900, there's probably going to be a lot of simple technician asset managers who will say, I don't like that. And they're going to begin to move assets somewhere else. Yeah, some of them have already done so, the wise ones. But the others have to be smacked in the face. But if that sort of event happens, there are probably going to be some more assets moving out of stocks and into what? Well, often the alternative is gold and bonds. That was the case in 2000 when the stock market peaked. Both bonds and gold went up in price. Okay, that was the case in 2007 when the stock market peaked. Gold and bonds went up in price. So they were both a pair of alternatives. Right now, though, the only alternative is gold. The question is, will bonds get themselves into a position where finally they're done for a while and they're going to have a major rally, possibly inversely to the stock market? I don't know the answer. We're timing it. We measure it week by week. We know the key numbers to break it out to the upside. But right now, the pressure's still on, and that's no doubt choking the Fed, though they can't admit it.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views. We've hundreds of thousands of different people listening in. So I just wanted to thank you. You know, I started this as a student, and now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening, and let's get back to the show. Yeah, no, that's a great point. So, do you think the stock market's going to have a similar, potentially come back down to the October low as well of close to 4,000? Is that sort of your base case?
I don't think they can inflate the stock market up anymore. I know when the stock market peaks and starts to enter a bear, that usually is coincident with Fed policy change. So they claim, no, we're not looking at the stock market. Baloney, okay. But even the data points that they claim they're looking at tend to follow the stock market, not the other way around. So the stock market's not going to go down because unemployment suddenly gets really bad for 5 months in a row, and then the stock market says, oh, I got to go down. Usually the stock market's top first before you really start to get hard negative data points, the kind that the Fed will panic over. So that'll happen with the stock market. But there's some levels below in the stock market. I mentioned Apple a while ago, which is, like 10% of the S&P, I think, or 7 or 8%, and a heavier weighting in NASDAQ 100. But stocks like that, you got to watch separate and apart from the market, because if you lose stocks like Apple, and let's say Microsoft, and they're both toying with levels on the long-term momentum that say, you go through there, you're going into a bear, okay? In the case of Apple, it's pristine. It's one of the most ugly potential topping structures I've ever seen in terms of what annual momentum of Apple looks like. Forget the price chart. And if it goes south, the market's going to go south. And there are some levels below in the stock market that if you tag them, you could go down precipitously. There's a lot of room between where we are now and getting to those trigger levels. I'll give you an example. Around 4,300 on the S&P. Now that number, if you look at a price chart, doesn't mean anything. Heck, we made a low last October of 4,100. Okay, so 4,300, that's 200 above there. The low of 2022 was 3,500. So 4,300 doesn't look like an important number, but if you hit that, you could fall apart rapidly because there's an annual momentum structure that will be broken there. It's what we do. We look at price charts secondarily. Same with NASDAQ. It's got some levels below it that you wouldn't see on a price chart. But if you go down and tag them, you'll no longer go down arm wrestling wise. You'll go down precipitously. I think ultimately they'll be triggered. The question is getting to those numbers. And I think that's an arm wrestling process. And once we get to those numbers, it will scare the heck out of people. And that's when you get panic flows of money.
Okay. And are you expecting this to happen sort of this year, or do you think it's going to spill over?
I think it's a this year event. The big, we look at various asset categories. There's the bond markets, the debt markets. There's the foreign exchange, which has been very dull for a couple of years now. The dollar index has been in about a 5-6% range for a couple of years, doing nothing effectively after it dropped sharply from 2022 high. And then you've got the commodity markets, which we measure, and they have broken out. Our assessment is that the bull surge that we saw from late 2020 to 2022, which we called in October of 2020, we put out a report called Commodity Explosion, and it exploded. Bloomberg doubled. And when the war broke out, Ukraine-Russia war, they peaked. Commodities peaked. And since then, they pulled back, and then they've gone dormant as a category, the Bloomberg Commodity Index, since spring of 2023, late 2022, actually, where basically they've gone sideways, the Bloomberg has. They've turned up a bit in price, not enough to excite people, but for momentum, it's been a significant breakout that occurred at the end of last month that tells us commodities are going to start their next leg up. And I think that one of the areas to watch this time, energy led the last one. It was probably the heftiest performer in that first wave up. The second wave up on annual momentum in the commodities, I think, could be led by the grains. Now, that's kind of politically sensitive. It's sensitive when you fill your gas tank. Everybody's painful. They see the dollars flicking by, But you take the price of wheat and rice up, and they've both broken out big time. It tells me that those are basic foods around the world. Suddenly you start hurting people in the price of bread. It inflicts pain, and pain creates doubt, creates uncertainty, creates panic. And the Fed will not be able to control it because they have other issues they have to control that will swamp them.
Okay, that makes sense. Yeah, because grains had a bit of it hasn't really had that increase, has it? It's been sort of since the
But they've done enough technical breaking out. The wheat and the rice, particularly right now, those are two core foods around the world. Corn is about to. Soybeans aren't far away. And already even natural gas, which got whacked really good. We were bullish for a couple of years. We thought we'd go to $9. It went to 10. And then it went down. We didn't know it would crash back into, below 2. So it went to free effectively. Now it's reasserting itself. And so is crude oil. And there's other commodities out there as well they're making the turn. So there's a lot of contributors. It's not just energy. Okay. And we think it's freshly begun. It may not explode right away, but it's going to start to move up. And so as the Fed has been fighting, quote, inflation, again, falsely and narrowly defined by them. Again, they don't care if they inflate the price of stocks, but commodities, heck with the farmers, they don't get high-priced corn. But we want stocks to be high-priced. Anyway, it's going to overcome them. They won't be able to stop it. So, as Jamie Dimon has said, he said speculatively, but I think he knows it's going to happen. Stagflation is here. So we're back in the late 70s, except I think even more dynamic situation.
Okay. And how do we get out of it? Can we, or do we have to just sort of try and get rid of all the debt?
No, I think there's. Pardon me. I don't allow my philosophy to get involved in my analysis, but I'm a libertarian writer. One of the first people to come up with the term anarcho-capitalist, which now we have a president in Argentina who declares himself to be an anarcho-capitalist. My analysis is that the errors of rising statism, where government controls more and more and more and more over the decades, whether it's democratically elected or not, but it still controls more of your life, that has created errors, especially the one involving their control over the money. Money's an essential commodity. It's my way of communicating with somebody I don't even know, thanking them for a good or a service, whether they're in China or they're in Europe or across the country. They made a product or a service and I'm buying it. In effect, that's my pat on the back to them. And I get something good, they get something good, okay? But for the government to come in and monopolize the pricing and the quantity of that essential commodity by their own wisdom from above, manipulates reality in such a way that it is not a free market in money. We claim to be free market, but when you have a monopoly government control over the quantity and the pricing, meaning interest rates of money, that's not free market. And it has distortive effects on people's interrelationships, on economic trends, false trends that are diluted by excess money, excess credit, low interest rates, then suddenly it goes the other way. This goes on and on. It's been going on since the Fed was founded, except this time they created the biggest bubble they've ever created in their history. And the consequences will be worse than the unraveling of all the other bubbles that they created. And I think it will be rapid. I don't think it'll be slow. Once the toppling begins, the fear increases, people take defensive measures. And there's the variable out there that nobody talks about. We raised it for the last year or so. That is the political variable. And I don't mean, I'm not going to take sides, okay? I'm just saying that the uncertainty, the outcome of this election, no matter who wins it, will be uncopacetic. And I'm not going to say it's going to be violent, but it wouldn't surprise me. The University of Virginia Department of Politics did a poll very cold methodological poll of likely Biden voters, likely Trump voters. This was last October. And they asked him certain very pregnant questions. And among the questions were, if the other side won, what do you think of that? And about a third on each side, I think that was the right number, said it would be adverse to the country, destroy America. And there was another question along the same line. If the other side won, would violence be justified? And it was an amazing double-digit percent on both sides, like 25 to 30% on both sides that say yes, it would be justified. And then they asked more and more questions along the same line, getting essentially the same answer with slightly differently worded questions. So they did it in the right way. So, but nobody's talking about that. Everybody says, oh, we have a divided country. Yes, you do. But the outcome is not going to be stable. And that is not priced into the markets. This is not a normal election. So, and again, I'm not on either side. I'm an observer from above. And I'm saying that is a factor that's not usually needed to be inserted into market analysis, but better be this time around.
Yeah, it's scary to think what will happen in a few months. But so you're seeing gold, as you mentioned it before, is going to be the safe haven because of the challenges that bonds are having at the moment.
It's the safe haven because it's always been the safe haven. It's always been, quote, money. It is money. It's been money for thousands of years, well before paper fiat currencies came and went over time. It's always there. And as the money units around the world depreciate in real buying power, like the dollar, for example, just look at an M2 chart. Every decade, basically, the money supply doubles. Over the last 10 years, if you go back from today, 10 years ago, look, it's more than doubled, okay? So what does that mean? It means the piece of paper in your pocket, its buying power continually diminishes. And it doesn't matter what happened in that decade almost. You can look at any decade, whether it had recessions, didn't have recessions, money supply doubled, okay? So, if you bought a stock at $10 and it's at 20 10 years later and you think you're making money, no, you're not. You're at best break even, So it's a factor that few people think about, but gold always prices it in. That's why gold, instead of $35 an ounce like it was in the 70s, is now $2,400 an ounce, and I won't project where I think it's going, but I think it'll be parabolic and it'll be off the page percent-wise from where we are right now even, and probably within 12 months.
Okay, well, that would be interesting to see. So, Michael, thanks so much for your time today. Really appreciate it. My last question is, what is one message people should take away from our conversation?
Take care. Watch all the markets. Don't just watch gold if you're in gold. It's impacted by the problems that exist in the bond market, problems that exist in commercial real estate, which will impact central banks' policy direction, which can reverse on a dime. Believe me, it will. It always has, and it will this time, because this time the bubble breaking is far bigger than any other they've created and then seen broken. So the monetary excess that's likely to follow will be probably historic, and gold knows that. You can reach us at olivermsa.com.
Perfect. I'll put that in the description below, but thanks again for your time.
Thank you, Anthony.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right. Thanks again.